Hello and welcome to Livewire's C-Suite reporting season coverage. I'm Sarah Allen and today I'm speaking with Inder Signh, the Chief Financial Officer for QBE Insurance Group. We're going to discuss QBE's latest results and the outlook for the future. Inder, thank you so much for joining me today.
Thank you for having me.
So to begin with, can you talk me through a couple of the key highlights that you found most interesting from the latest annual report?
Yeah, so the couple of key things that really stood out for us this year was firstly our combined operating ratio, which is the main reflection of margin in our business, and we reported a combined operating ratio of 93.1%. So in essence, what that means is for every $100 of premium we collected, we made about a 7% margin. We're very proud of that because that's a strong number, but also we're increasingly building a track record of being more consistent around that. So I think that's a really important number. The other number that really stood out from my perspective was the growth number. So we grew the core part of the business about 9% year on year, which for a financial services company is really pleasing. And so we've got a wonderfully diverse business around the world with many products in many geographies, and we're seeing real opportunities to continue to grow the business into 2025.
You just renewed your 2025 reinsurance program. Were there any changes in structure or cost?
Yes, so we've been working with our reinsurers for a number of years, and we've got some really good, strong relationships with many of the big reinsurers around the world. So in terms of the structure of the program, it was broadly similar to 2024. The main change has been what we call a drop in the attachment point. What that really means is, we at QBE have done a huge amount of work in improving the quality of the portfolio. So taking out some of the peak risk, both in the US and in Australia. And, it was really pleasing that through the reinsurance discussions, we were able to reduce our exposure to some of that by having the reinsurers attached at a lower point in the program. And so what that really validates is all the work we've done to improve the quality of the portfolio, and it gives us better coverage into 2025. The overall cost, in terms of the margin impact, was relatively modest.
The last few years have seen double-digit annual growth in the cost of insurance premiums and other financial services. Last year, for example, was around 11%. Will investors see some relief this year?
Yeah, so look, it's been an important area of focus for us. We're obviously keen to make sure that affordability and access to insurance remains as strong as possible. The main reason prices have been going up is because the cost of risk has been going up. We're seeing just a record frequency of events in terms of weather losses across the world. 2024 was another record year for industry losses. So, what the insurance industry and QBE in particular is trying to reflect is, the increasing cost of risk. We've also had inflationary pressures in terms of home price, repair costs and/or motor repair costs, etc. And we're trying to make sure we address those, through the price increases. But, our sense is moving from 24 into 25 that the rate increase should start to moderate from here. The margins in the industry are now starting to stabilize, and hopefully, we can make sure that the customers see some relief in terms of the level of increases they've seen in recent years. But there's more for us to do, both as an industry, with working with the governments and regulators to make sure that things like mitigation get focused so we can continue to make insurance an affordable product.
Just following from that, to what extent does QBE actually set those premiums versus other factors?
Look, we have a lot of input into how we set the premiums. I mean, what we try and do is we assess the risk that we're writing. We try and use the latest view of modeled risk, whether it's catastrophe risk or whether it's liability risk. We then assess what we think we can earn in terms of investment returns. And all of that goes into what we think is ultimately a reasonable price to charge to deliver our target returns.
So natural catastrophes like California wildfires have been an ever-present threat. How is QBE factoring this as part of your strategy going forward? And how are you working with customers to reduce the risks of these events?
So that's really a case in point on some of the things we've touched on already, which is, the frequency of these events continues to increase. They're also happening in places where historically we probably didn't have as much population or sort of home building. And so the frequency is up, but also the impact when losses happen is more significant. So I think continuing to work on our understanding of risk and how we price that, but also communicating more actively with the customers in terms of what can they do to help mitigate the risk, and making sure we then recognize and reward mitigation efforts. And I think this is where, to my earlier point, working with governments and regulators is also very important, right? To make sure, as we think about planning, as we think about what we can do in terms of rebuilding, whether the materials we're using or the location we rebuild in, are all things that go into making the world a little bit more resilient given the context we're now living in.
What has the increasing global uncertainty meant for QBE's investments? Have you had to change the way you positioned your portfolio to factor this?
Yeah, so it's obviously investment volatility is ever present. We're continuing to see that in 2025. I think importantly, we haven't changed the risk settings in our investment book. So we manage about 30 billion in assets. The risk settings are roughly 15% in risk assets and 85% in what we call core fixed income. So that's highly rated bonds around the world. I think the investment team has done a wonderful job at managing some of the volatility, but staying very much true to our risk settings in terms of how much capital do we deploy towards investments. And having said that, I mean, in 2024, not only did we manage volatility, but we delivered a very strong result. The investment result was about $1.5 billion, a record for the company, so we're very pleased with that.
But given the proportion that's in fixed income, have you had to make any shifts in the type of fixed income that you're using given the easing cycle?
We look at really matching the duration of that book to our claims duration. So what we're not trying to do is run any mismatches across the balance sheet. So we're trying to run relatively measured risk settings. But as our claims have extended in duration, we've been able to extend the duration of the asset book a bit. And so as part of that, we've picked up a little bit additional term premium, and that's really helped in the context of the returns.
So QBE recently announced it's redefined its key priorities for the year. Can you take us through 2 to 3 initiatives that you think are going to generate the greatest returns or efficiency this year for QBE?
I think sticking to the theme of consistency, our 2025 priorities are very similar to our 2024 priorities. We are, though, putting a bit more emphasis on growth. The momentum at the end of 2024 has been strong. We have wonderful diversification in terms of products and geographies where we see opportunities to grow, particularly in our international business, in the Lloyd's business, where we're a leading player in the UK business and our North American business. So some really good opportunities for us to go after in terms of growth going forward. We're also investing meaningfully behind some of these growth initiatives in what we call the modernization priority. So really focusing on making the business more responsive from a customer point of view. So, quicker to quote, quicker to assess claims, and really making that customer experience and the broker experience a lot more seamless. And so a big part of the ambition is to make the organization not just more effective, but easier to do business with. So I think growth and modernization are the 2 important priorities into 2025.
If there was one message you wanted QBE investors to take on through this year, what would it be?
It really comes down to consistency and lower volatility, right? Like we've been focusing on those things for the last 2 or 3 years. We've made great inroads, and I think there's more opportunity to continue to do that. And that consistency really applies in terms of how we go to market, in terms of the appetite we set, how we manage, our employees and some of the cultural dynamics within the organization. And then ultimately all of that should result in more consistent financial results.
Thank you so much for taking us through the outlook for QBE.
Thank you so much.
If you've enjoyed this interview, please subscribe to Livewire Markets for more in our C-suite reporting season coverage. Thank you.